The US stock market just saw $1.7 trillion in value wiped out in a matter of hours, all triggered by renewed tariff threats from Donald Trump on Chinese imports. Trade tensions are ramping up once again, and although Trump has already backed off his initial big threat, the trade war of 2025 is still having a real impact on the ground. We can see that in this chart. It shows how often US publicly listed companies mention the word tariffs on their earnings calls. And this year, those mentions have surged to a record high. Over 2,000 companies have brought it up. Tariffs have suddenly become the most important word shaping the US corporate outlook. US tariff rates are now projected to climb to their highest levels since the Smoot-Hawley tariffs of the 1930s. Back then, the US imposed tariffs of around 20% on foreign goods to shield domestic farmers and manufacturers. But that protectionism backfired. Other countries retaliated, and global trade collapsed by 66% between 1929 and 1934, turning what began as a recession into the Great Depression. Economic growth just vanished, and US corporate profits went from $1.7 billion in 1929 to a $600 million loss by 1933, 3 years after the start of tariffs that were meant to protect American businesses from foreign competition. Given that we're seeing tariff rates climb back toward those extremes today, it raises a pretty straightforward question. Could this lead to another kind of trade slowdown, or is this time different? I know you're thinking, hold on though, the S&P 500 is still near all-time highs right now, and we've bounced back from that 20% tariff-driven sell-off earlier this year that erased nearly $10 trillion. Markets have a way of recovering quickly, and with corporate earnings still looking pretty solid, it's easy to feel like the tariff worries might be overblown. But the full picture might not have come into focus yet, because those initial market reactions don't always capture the longer-term effects on company bottom lines. So let's look at this step by step and see if tariffs are really set to disrupt earnings, or if the market's optimism has some real ground to stand on. At their core, tariffs are just taxes, essentially a toll on goods entering the country. When a product crosses the border, the government charges a fee, and someone has to absorb that added cost. Those costs can feed into higher prices for goods and services, which in theory can slow down demand and weigh on the economy. But the full effects of tariffs don't hit all at once. According to Goldman Sachs, about 64% of the new tariff costs until June 2025 have been absorbed by US businesses rather than passed on to consumers. Yes, in the first few months after tariffs are put in place, importers typically absorb most of the added costs. Existing contracts and stockpiled inventory help cushion the impact, and that's exactly what we've seen so far. We can see evidence of the stockpiling behavior in the US import data, which shows a sharp spike in the first quarter of this year. Many companies front-loaded their imports in anticipation of tariffs, bringing in far more goods than they immediately needed. This has allowed them to keep selling at pre-tariff prices, effectively delaying the hit and keeping the initial inflation impact muted. So that means corporate profit margins remained strong in the second quarter of 2025 despite the new tariffs. In fact, S&P 500 profit margins just climbed to 12.8%, their highest level since 2021. At the same time, overall earnings for S&P 500 companies hit new record highs, becoming one of the biggest drivers behind the market's recent rally to all-time highs. But these buffers might not last forever. The stockpiles will eventually run out, and the true cost of tariffs could start showing up on the company's results. In fact, economists have found that tariffs' impact on inflation typically peaks about a year after they're introduced. As those early stockpiles are depleted, companies start facing higher costs on new shipments. To protect their profit margins, companies may begin raising prices for consumers, which can feed directly into higher inflation. Smaller firms without pricing power get hit the hardest. Their margins get squeezed, and they often respond by cutting jobs, slowing wage growth, or scaling back investment. This is where the economy could begin to feel the full weight of the tariffs. According to these economists, we could see tariffs potentially get passed through supply chains. Prices gradually rise, especially for everyday goods and services, and that starts pushing CPI inflation higher. As inflation climbs, households' purchasing power erodes and demand begins to cool. Corporate profit margins start to roll over, and companies slow down their hiring to protect costs. The result could be downward pressure on stock prices and perhaps even early stages of a recession. Some analysts even expect that profit margins for S&P 500 companies could start slipping as early as the third quarter of 2025. That said, some analysts suggest we could see a different scenario. We could see tariffs push prices higher, but only as a one-time effect, not a driver of sustained inflation as some economists suggest. Meanwhile, other factors could potentially help offset the impact. For example, a weaker US dollar could quietly support corporate earnings. When the US dollar weakens, overseas revenues translate into more dollars once brought back home. Expenses abroad stay the same in local currencies, but reported revenues in USD rise, effectively lifting profit margins. And that matters, because about 42% 40% of S&P 500 revenue comes from overseas markets. If this plays out, the tariff shock could potentially fade without triggering a major downturn, more of a speed bump than a roadblock. Stocks might see a pullback or brief consolidation, but could continue climbing higher. So for now, it's still uncertain how tariffs will ripple through the economy. Investors still believe that resilient corporate profits, supported by factors like a weaker dollar, cost efficiencies, and stable margins, could outweigh the headwinds from tariffs. However, sentiment can shift quickly. If consumer demand softens more sharply, if tariffs intensify, or if the dollar unexpectedly strengthens, those supports could fade, leaving earnings and markets more vulnerable. At Capital.com, we'll keep you updated on key market developments and other macro trends. Hit like and subscribe to stay tuned. Thanks for watching.